I want to replace my balance sheet with some property, a non-currency derivative. So I either buy a building, or I buy land, or I buy a portfolio of art, or I buy gold, or I buy some crypto gold, right? And after sifting through every possible property, I settled upon the idea of crypto gold, and then I sifted through 6,500 cryptos, and I figured Bitcoin is the closest thing to digital gold on the dominant network. It's the least risky of the crypto assets, and it's the one that is acknowledged as a property. So now, if I've come to that conclusion, I've got my general counsel, my CFO, I've got my outside auditors, I've got my outside counsel, law firm, and I've got my board of directors.
MicroStrategy CEO and Bitcoin advocate Michael Saylor spoke out about the recent raft of restrictions that are looming over the crypto industry. Some regulatory bodies worldwide are becoming more oppressive and hostile towards Bitcoin and digital assets. This has been increased by the Russian invasion of Ukraine, as policymakers suddenly think that the former will suddenly switch to using cryptocurrencies. Other watchdogs are growing concerned about the excessive energy demands of proof-of-work Bitcoin mining, though it still uses less than all of the fridges and TVs in the United States alone. Keep on watching this video till the end if you want to know Saylor's response to banning Bitcoin. Hello and welcome to Money Talks. In today's video, Michael Saylor talks about how he got involved in crypto, the political considerations with crypto, visions of Bitcoin as a property, and the current macro and microeconomic outlook on investing and inflation. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
Well, I became a big believer in big tech and the mobile wave around 2010, and I made large investments in Apple, Amazon, Facebook, and Google between 2010 and 2012. And during that time period, there were a lot of haters of Amazon. They hated it. A lot of people would tell you if Apple stock doubles, you should sell half of it and diversify into the other computer companies. When Amazon goes up, you should sell half of it and diversify in the other retail companies. What are these things? I don't get it. And, my view then was it doesn't make sense to sell the big tech dominant monopoly because it's going to eat everything. Right? One company, Amazon won, Walmart kept up, every other retailer, 15,000 retailers lost. With Apple, one company won the mobile wave. They got 150% of the profit in mobile phones. Every other company lost money to compete with them. And so my experience as a private investor is you got to figure out what's the dominant technology that's going to win in the eyes of a billion people. They have an overwhelming lever. Once you figure that out, if 98% of the people disagree with you, it's probably a good investment. Like, I could have lined up everybody on Wall Street in 2010. You can go back and you probably had a parade of people, talking heads on television, telling you why Amazon didn't make money, they're never going to make money, blah, blah, blah. And here we are today. And the appeal of Bitcoin is, it's just a savings account in cyberspace run by software. It's like Bitcoin is like a savings account run by software, and it's incorruptible. The software doesn't get to change the rules. You're not guessing whether they'll hit their quarterly earnings. You're just putting your money in that bank in cyberspace, and you're waiting for a decade. And over the course of a decade, after you smooth out all the volatility, it's outperforming the S&P. There's no CEO to give himself stock options. There's no board to issue credit or debt and dilute you. You don't have to worry about your stock triples and the company sells more stock. All you're doing is you're converting what is a weaker form of property into a stronger form of property and waiting for a long period of time. So cryptocurrency is a stable coin. Every stable coin is in essence a crypto dollar. And the world wants to move crypto dollars around because they can move them at high velocity and they solve a problem. I can settle every 3 hours, and I can trade 24/7, 365. And so there's a place for high velocity currency. But property solves a different problem. I'm sitting in Argentina, and I want to trade my weak property. Weak property is a business that sells stuff in pesos, and I want to convert it, and it's limited to Argentina. I sell my building, I convert it to Bitcoin. My Bitcoin is valuable and desirable to anybody with money in London, Paris, Beijing, or Moscow. My building in Argentina is valuable only to someone in Argentina. I can rent the building for pesos. I can rent the Bitcoin for euros or dollars, right? So weak property goes to strong property. Weak currency, the peso, losing 80% of its value in a year, goes to the dollar, losing 15% of its value in a year, right? And when you think that way, you realize there's a massive demand for strong property everywhere in the world, but there's even a bigger demand for strong currency. So the cryptocurrency is the stable coin, it's the tether, it's the circle, it's whatever the United States endorses. If a bank like Silvergate issues a stable coin, that's going to be cryptocurrency. First of all, I'd say you can't be an investor without understanding and having a macroeconomic outlook and a microeconomic outlook. If you're going to own stocks, and you own international stocks that actually sell their products in South America, you have a partial currency derivative, and you have to have an opinion on the real, the bolivar, and the peso in order to own the stock. If you're going to own an asset, you got to understand, is it a currency derivative, pure and simple, like a bond, an Argentine bond, a US bond? Is it a 100% currency derivative? Or is it a partial currency derivative, like a value stock? Or is it a property, like owning a Leonardo da Vinci painting that's valued just for the essence of its ownership? So my macroeconomic view is there's 130 currencies that are floating right now in one shape or form. The strongest currency is the dollar. It's losing purchasing power at maybe double the rate it was losing purchasing power before 2020. So if it was losing 7 to 10% of its purchasing power a year, it's now losing 15 to 20% of its purchasing power a year. We're going to stay in an environment for the next 4 to 8 years where we're going to run higher deficits. We're going to have a lower interest rates, looser monetary policy than we had before 2020. There's just a question of, are you a 15%er or a 20%er or a 12%er? But I don't think anybody reasonably can expect that we're going to go back to a tighter money policy than we had in 2019 or 2018. Well, you know, I'm not a trader, and so my short time horizon is 4 years. During 5 years, well, I'll take that kind of risk. And my normal time horizon is a decade for a forecast, and the ideal time horizon is forever. It's property. Do I want to own Manhattan? Do I want to own London? Do I want to own gold, or do I want to own Bitcoin for the next 30 years, right? Having said all that, right, the way Bitcoin trades oftentimes is it trades like with the derivative, the acceleration or the jerk or something of the money supply. So the fast money traders control it in the near term, and they will tend to kind of do the opposite of the long term, which I find interesting. When the Fed said there was no inflation, right, people come on television and say, there's no inflation, maybe you don't need Bitcoin because Bitcoin's an inflation hedge. And then the fast money trades against it for a bit. Mm-hmm. And then another week or 2 weeks go by. And then once you get outside the fast money, the momentum, the more fundamental players come in and they start buying it up, and it accelerates. And I think when the Fed says, well, I guess there is inflation, we've got big inflation, but we recognize it's a problem, the fast money says, oh, well, they recognize it's a problem, so it trades against Bitcoin. Like, well, the Fed's going to treat the problem. Mm-hmm. And you're in that dynamic. And then I think eventually over time, the longer term investors come in and they start to drive it the other direction.
The European Union is preparing to vote on a markets in crypto assets framework that could result in heavy restrictions on POW mining. It is reported that a new law could be a de facto ban of Bitcoin and Ethereum, still POW, in the EU. As a response, Saylor tweeted that proof-of-stake assets will be deemed securities, which is why proof of work is still highly relevant and needed. The only settled method to create digital property is via proof of work. Non-energy-based crypto approaches like proof of stake must be deemed to be securities until proven otherwise. Banning digital property would be a $1 trillion mistake. Saylor, who has welcomed productive regulations, added that Bitcoin is digital property and the most cost-efficient method we have yet discovered for converting energy into prosperity. Additionally, Europe comprises about 12 to 14% of the total Bitcoin mining hash power, according to August 2021 figures from Cambridge University. Ireland and Germany have the lion's share of that total, so global hash rates are unlikely to be impacted. So what could happen is a wider ban or heavy-handed regulation, which could harm the markets and the industry. Tell us your thoughts about this in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.